Welcome everyone to Bombay Chartered Accountant Society's Tax Gurukul Season 2. Myself, CA Ronak Rambhia, the Tax Gurukul for this month. Since the tax filing season is about to end, we thought we'll just share our views on the pending income tax return filing and the processing of return. There would be still many assessees who would be wanting to file their return, but since the due date for the normal tax filing has gone, so for the benefit of them, this video would be benefit to them. So what I would be covering in this video would be the belated and the revised return, the rectified return, the updated return, how the processing of the returns which are filed will be done, and something known as the TDS provision. So to begin with, what are the provisions which are included in this is for the normal tax return. This tax return is filed under section 139(1). For the revised return, it is filed under section 139(5). For belated return, it is under section 139(4). For the rectified return against the defective notice, it is section 139(9). And the updated return is section 139 subsection 8A. Going forward, for the revised or the belated return. So if you have filed your return before this and you want to file a revised return, or if you have not filed a return till now and you want to file the return since the date under section 139(1) has already been passed, you can file a belated income tax return. So revised and the belated income tax return can be filed before 3 months from the end of the assessment year. That is, for assessment year 24-25, you can file up to 31st December 2024. Further, the carry forward of losses is not available in the belated returns except for the unabsorbed depreciation, which is allowed to be carried forward. The selection of tax regime is not allowed after the original due date of filing under section 139(1). So the default tax regime is applicable for the belated return. So for instance, for returns for assessees of individuals, the default tax regime is the new tax regime, and hence they will not be able to choose the old tax regime. In case of the late filing fees under section 234F for the belated return, so if the income is above 5 lakhs, the penalty or the late filing fees is 5,000. If it is below 5 lakhs, it is 1,000. For individual assessee, if the income is below the exemption limit, then late filing fees is not applicable. Further, going forward is the rectified return. You would have seen this for the returns filed by you, that you would have got a notice from the income tax saying that rectify the defective return of income. So rectified return can be filed against defective ITR notice within the specified time mentioned in the notice, that is normally the 15 days from the notice date. Further, if you have received this notice, then the assessee has to either agree or disagree to the said notice. If you agree for the defective notice, you can file a rectified return. Or if you do not agree for the said notice, you have to mention the comments or the reason for disagreeing the notice and ask for reprocessing the same old return filed. The rectified return is filed through the e-processing tab against the said notice. It is not filed in the normal e-filing tab. And if there is a change of tax form, that is from ITR 1, 2, 3 or 4, interchange form is there for the assessee to be filed against the defective notice, then a revised return can be filed against the same. But a defective ITR, in case of defective ITR, you cannot change the tax form. Going forward is the updated return. So for example, if assessee has not filed the return for year ending March 22 or March 23, they still have time to file their return of income subject to conditions. So section 139(8)(a) allows you to file the updated return within 24 months of the end of the relevant assessment year with an additional tax as per section 140(b)(3). One can refer to the FAQs, particularly question 10 and question 12 for the same. So for assessment year 22-23, assessee can still file up to 31st March 25 with the excess tax rate of 50%. And for assessment year 23-24, one can file up to 31st March 25 with an excess tax rate of 25%. And up to March 26 with an excess tax rate of 50%. Plus the interest would be as applicable. So here, which assessees are eligible for updating their income tax return is if you have not previously filed your return of income not reported correctly, you have chosen wrong heads of income, you want to reduce the carry forward loss, you want to reduce the unabsorbed depreciation, or you want to reduce the tax rate under section 115 JB or JC, or if there is any wrong rate of tax applied in your normal return, or there may be other any reasons for it. So this is where one is eligible to file the updated income tax return. Further, in case of which updated is not allowed is updated return cannot be a return of loss. It cannot result in refund, decreasing the tax or increasing the refund for relevant assessment year. So you cannot have an updated return which has a refund attached to it. It can be furnished only once for relevant assessment year. It is not allowed if search or survey has been initiated, if any proceedings is initiated, pending or completed for the relevant assessment year, and if AO has information in respect of such person under Money Laundering Act or Smugglers Act or Income Tax Act Section 90, and the same has been communicated to the assessee prior to filing of the updated return. So just to summarize, you can file the ITRU within 12 months from the end of the relevant assessment year by paying a 25% additional tax plus interest, 24 months of the relevant assessment year with paying additional tax of 50% of the tax plus interest, and the late fee as discussed of 234F. So this is where you can file the returns belated, updated, rectified also. Further going to now you have filed the return of income. Now what happens is where the return is filed and duly e-verified by the assessee. Further, it goes for processing. ITR is either processed or still under processing. For under processing, it only for the reasons known to the income tax department why it is still under processing. One can put grievance under for processing the ITR if it is still under processing. And in case of ITR process, you would have received intimation under section 143(1) or 143(1)(a) mentioning any adjustments. In case of 143(1), there would be either no demand, there would be refund due, there would be some demand, or you would have got a defective notice. So in case of no demand, or in case of refund due and the refund is credited to your bank account, you have happily successfully completed the tax filing. In case of the refund is adjusted against the outstanding demand, one has to go back to the outstanding demands and put reason and call for the full refund. In case if the ITR is processed with demand, one has to verify the intimation under section 143(1) and accordingly file a revised return, and you may get the intimation under section 154 with the correct refund due or no demand. And in case of a defective notice, you have to refer it as what we discussed. You can file a rectified return or give reasons against the defect. So once everything is completed, then the refund would be credited to your bank account. In one or few of the cases, you would have noticed that you would have received demands or the TDS credit is reduced. So in that case, we thought I would like to discuss that also. So just a few slides where it would say that in case of TDS, which is actually a TDS, so there are 4 instances in which I would like to brief. One is income and TDS. If it is in the same year, you disclose the same correctly in the tax return, and you will surely get the tax credit correctly in the tax return. For example, in instance 2 is income is in year 1 and corresponding TDS in subsequent years. Now there is a scheme for e-filing form 71, which is an application for claiming the TDS credit along with supporting documents and mentioning the requisite details in the form, wherein you can mention the details and claim in the relevant assessment year in which the income is offered. The time period for filing form 71 is 2 years from the end of the financial year in which the TDS was deducted by the deductor. Third instance is TDS is in year 1 and the corresponding income is in subsequent years. So assessee can carry forward the said TDS credit and claim the TDS in the year in which the income is offered to tax. You can refer to Rule 37BA and Section 155 subsection 20 for the same. And the last instance, what I would like to discuss is transfer of TDS from one person to another is also allowed in the income tax return. You have to mention the PAN for to which the income and the TDS belongs to, and the TDS is rightly transferred to the another assessee. These are some of the insights on the appending tax return and the processing of returns. We hope you would take the benefit of the same, and the presentation would be there in the comment box. Thank you everyone for watching this on behalf of Bombay Chartered Accountant Society. Myself, CA Ronak Rambhia, the tax guru for this month. Thank you so much.